everyone. It's nice to join you. So thank you, Rory. I'm Laurel Patterson from UNDP, and I'm going to share a couple of remarks and sort of guide us through the discussion. And one of the things I wanted to put up, so I work on the Global Sustainable Development Goals agenda for UNDP. That's the biggest development program in the UN system. And to put that in context, that we deliver about $5 billion annually in our partner countries. We're present in around 170 in territories that world. What we're seeing is a really challenging context. And I think that's an important place to start, because one of the things that would be important for all of us is we get the question. Financing and private financing for the level of complexity that we're seeing is we first need to realize where we are, which is an extremely complicated and very, very fractious landscape. One of the things we run at UNDP is something called the Human Development Index. And this goes beyond looking only or categorizing a country's development in terms of impact, but also in terms of opportunity and the way that that's expressed in health and education and standard of living. And when we look at that this year for the first time, and I know we hear that a lot in the media, but so for the first time this year, what we're seeing is a divergence. We've been seeing a convergence over time between the countries that are at the highest level of human development and the lowest. That gap has been narrowing over time. For the first time, we're seeing that change, we're seeing this divergence. And I think it's important and speaks to the conversation that we're going to be having here, because what we need to be aware of, see clearly, and then actively work against this growing divergence. How do we stitch back the kinds of convergence that we need to tackle global challenges? And I was speaking at an event a little bit earlier this morning. So we've titled this Wall Street and the SDGs, moving from talking the talk. But my guess for all of you in the room is that it's not something that you don't see and experience and feel deeply about. So the question for us, we'll discuss it with the panelists over the course of the next hour or so, is not so much do we need the wake-up call. If we have the wake-up call, you're all here, which suggests to me the wake-up call, check done. But what does that instruct us? What does that tell us needs to happen next? And one of the other features of the world we're living in right now is one for which we see higher standards of living than ever before. So, you can look at different numbers, poverty eradication over time and so on. You see positive developments. But you're layering on top of that now the reality that in every single country, from richest to poorest, we see heightened levels of perceived insecurity. How can this be? How is it that even in countries that objectively are doing much better and continue on positive trajectories, we feel insecure? And I think the reason why that's important for our discussion today is that it creates a paralysis. So that question that we're asking ourselves, we want to be part of a conversation like this today. We want ideas and we want to act on them. These constraining factors, sometimes they're almost invisible, that create insecurity and so on. It actually strains us from acting. We feel a little hopeless. We hope somebody else will do something. We read the media and we say maybe think about something else. Maybe we not try it at exactly the time when we need to and need behind these big challenges in a way that we've fully been able to leverage in the past. So I'm really excited to talk both with John and Heather. And what I thought might be a nice way of starting rather than me is just giving you each an opportunity to introduce yourselves. And then we're going to open up a discussion in two ways. First, we're going to look at some of the barriers. So what are the realities and the challenges that we're seeing? What makes this so difficult? And then go into the conversation of where are the opportunities? Where are we seeing solutions? Where things start to move? And how can we double down our focus as well as our investment in those areas? And then we'll give you an opportunity to ask any questions back. And you should know that if you don't have questions, we have questions for you.
Thank you, Laura. Thank you, Heather, and thank you, John. And of course, thank you to the entire audience, both here and joining us by Zoom. It's a total pleasure to be here with you all today to discuss what I see as one of the most important challenges, both for capital markets and for the non-capital markets players here. But a bit about that. I'm Jonathan Chandler, the Chief Operating Officer for Syntax. We're a lot of different hats, but I work pretty closely with our underlying data, where we measure what percent of the company's revenue is coming from various sources, and then how does that map to hundreds of different thematic groups, including a number of groups focused around ESG impact and sustainability topics, including the SDGs, which provide various framework for understanding what products and services are ones that are hopeful to solving all the challenges that Laura was talking about. I also work closely with the other side of our business where we build financial indices. That's the indices that we built in collaboration with the great folks at 17.
Good afternoon. I'm Heather McKee. I'm the Chief Executive Officer at 17 Asset Management, and we are thrilled to be here and really thrilled to be using Syntax and their Affinity platform and their grouping revenue line items to the SDGs and allowing us to create the type of products that we've been able to create. And we'll share more about them today. But I think we're in that way. And we're lucky that we get to leverage Syntax for what our mission as a firm has been since inception, which is to create financial products that are solving problems. And we use the 17 Sustainable Development Goals to do that as we do their frameworks that everyone has already agreed to, and they do have 4 metrics underneath that you can track and measure and hold accountable businesses and governments to account. And so at 17, we build financial products alongside the and the public equity strategies that we'll be talking about today. We're really excited to be launching, and so happy to be here. Thank you.
Thank you, Heather. John, can everybody hear me okay? Well, it's very humbling to be here today, and I'm really looking forward to this discussion. The SDGs, I believe, are an important catalyst for what's going to evolve our capital markets and our societies and bring our world together in a more collaborative way. And I think that we're at a very important inflection point in a lot of regards in terms of what's happening within the capital markets, the geopolitical world, and opportunity and aspiration that hopefully we'll be able to talk to today. Sustainable Leaders is a platform of investment professionals that are focused on providing investment solutions to institutions and net worth clients that drive impact. You know, we're trying to facilitate bridging a legacy of sustainability within our society and what that could be. And that's really our mission. We have 9 affiliated boutiques on the board of advisors to 17 Asset Management. We're looking forward to collaborating with them on a global basis to deploy capital, improve opportunities for people, and returns for investors as well for the capital that we're putting in place. So looking forward to the dialogue today and hopefully interactive.
I'll try and ask questions in order so that we get this choreography right. Jonathan, let me ask you first. So we've heard from the other panelists, and I know it's a shared sentiment from those in the room that investing in areas that are aligned with the SDGs, it tends to have multiple wins. It has the potential for multiple wins, right? The more that you invest in renewable energy, you're also investing in resilience. You are investing in climate proofing a city, for example. You could be investing in a way that also clean energy tends to have a higher gender parity in the jobs and so on. So there's all of these different ways. And yet we don't see a whole lot of products that exist and are moving in this direction. Why do you think that is? And what do you think is some of the most important qualities or characteristics of the product need to be robust and taken seriously?
Yeah, probably a great question to start with. The products need to be good products fundamentally. Part of that is investment return in some of the older school ESG and SRI for that prior to the SDGs. And niggling returns, and I think that put off a lot of folks. I don't think that's so true anymore. I think it's possible to generate really strong return characteristics while also, like our CEO Patrick, directing capital to companies that are deserving of it. That is really what we're trying to do here. But it's hard to do that if you don't have good data on what the companies are actually doing. And so I think there's a fair number of products in the market that just don't really deliver on a specific one-size-fits-all kitchen sinking type products. When I first met you, Heather, we were talking about that intentionality behind investors years ago. And I think it's really important to have that intention of an investor saying, what do I want to accomplish with a given product? And the SDGs give the product framework for allowing us to do that. But the investment community has been a little bit slow to pick up on how they can map companies to whether or not they're aligned with those. And it in all the traditional fundamental data about is this a good company to hold? Do they have strong fundamentals? Do we like their cash flow? Do we like their market position? And all of that is very important too. So you got to take into consideration a lot of different dynamics. Is the company's product and service helping the world? Being operationally doing a good job of it, and then does that get reflected in their financial statement? And so I think directly to the question, it's been tough for the community to do that because that's a lot of disparate things to bring together. And recently, the data on some of those elements has not been that great.
Let me ask you a quick follow-up. What does it look like in a large company that is doing well in some areas, not so great in others, may have some huge opportunities? There's a series of risks as well too. How do you assess both companies that are doing well in different areas? They could have trade in different areas, and the directionality in terms of are the most progressive areas moving faster in a company, and do you take that into account? Or are those relatively stagnant and some of the bigger risks are moving faster? How does that factor into the way you work?
Yeah, it really comes down to what the goal for the product is. I think there's room in the market for some products that are focused on the best growers, even if they're not there yet. Other products that are really holding the best of the best that already are there. And those are going to have different return profiles and different characteristics that deliver on different intentions for the underlying investors.
So maybe just hand to Heather a note. Hear me, and you'll hear me in the room. So Heather, tell us a little bit about the solutions that you're working on.
Absolutely. So one of the points that you've just made, Jonathan, is the timing of this all. And it's so true. We've been in a maturing phase for a number of decades, really, in the learning how to factor in additional data, additional lenses, additional purpose or intentions into the development of a financial product. And the data has to be reported first before we can assess it and then determine whether or not a company is meeting whatever standard we've set out. And so it is a Goldilocks moment in time where companies are reporting more, and then we are able to take that data, stratify it, identify where it maps to, and then use those that language, essentially those tools to filter in and out companies that are meeting what our criteria are as investors. And so the indexes that we are creating, the 6 that we're launching today, are aligned to 6 of the different SDGs, and each basket or each index has companies within it that have material revenue, up to 50% or more revenue aligned to each of those goals. So if you are looking at our SDG2 index, it's food systems, right? And so you're going to see consumer staples being the primary company underlying stock in that list of securities. And you look at our SDG7, you're going to see industrials, you're going to see, my little cheat sheet here, utilities, right? You're going to see an SDG3, you're going to see healthcare companies overweighted in the index because we're looking to invest into good health and well-being. And not only are those companies materially aligned to the sub-indicators around the goals, they are better companies generally because they're surpassing a lot of the other fundamental requirements that we're putting on our rules to determine their cash flow, their operations, their other factors that go into determining whether they're a good investment generally, and are they also having a positive impact aligned to the goal we're looking to achieve. This is a very simple way for someone to get quick exposure to a number of companies that are best in the best around the impact that they are aligned to.
Yeah, maybe I can follow up. We have a saying that sustainable leaders, if you can measure it, you can manage it, right? So investment managers, data analysts, right? They have to play with their toys, which is data and information. And I think what's happened over the last 4 or 5 years is non-financial data now has become mandated in Europe and in the SEC, and this data is going to become quite important. in terms of evaluating the sustainability of companies, how capital is being deployed within those companies, and what that can mean from a transformational perspective. Most companies do damage. It's a large spectrum. There's 17 SDGs. Not every company can be good at every point. So there's a lot of gray area. There's a lot of gray area in impact. There's a lot of gray area in returns and investing. Investments, you're not always right. So some of our best managers are right 55% of the time. And we'll have these discussions about impact and SDGs, and you have to be right 100% of the time, on your SDGs. That's not where change takes place. Advancement and change takes place in experimenting, succeeding, failing, learning from the failing, and then quantum leaping. And so, when you have an eye on data and information and more being provided now from these corporations and mandated, that's going to be a big catalyst to manage these SDGs much more effectively, to align to investors' values and be a catalyst for opportunity really down the road. So I think it's an exciting time to be launching these products because I think the foundation of the information is a lot stronger than it has been.
John, thanks. I think an important point you're making as well too. One of the things that's unique about Sustainable Development Goals is they're the world's only systems agenda. So it wasn't designed to exist in different boxes. We have a tendency to put them in there. They all interact with each other, and there's trade-offs. And the important thing about trade-offs that we see from a policy perspective is that it's almost more important to work for mitigating or limiting the trade-offs than it is to capitalize on an opportunity, because it's those trade-offs and drawbacks that pull your work, your investment potential in this case down. So we turn back to you. When you look at the landscape and when you think about your work, where do you see as some of the most critical pain points or concerns on your mind, and how is Syntax thinking about those?
Yeah, I think there's really two different things that keep me up at night on this side of things. One is that the markets can't solve all on their own. And Heather, I think we're getting at this, right? We need companies to be reporting data. We need regulatory mechanisms to make sure that they are reporting data accurately. There are auditing systems that need to be in place, some of which are there today, some of which are hopefully coming. The Europeans are a little ahead of the Americans on that. But to make sure that what's being reported is actually accurate and measurable. And there needs to be political will that we've seen slipping a little bit in recent years, especially here in the US, less so internationally. I remain optimistic that those are solvable issues, but no amount of capital markets working without the support of the rest of the systems around this can solve all. That's kind of one thing that worries me a little bit here, is the effect that we can have on. The second is that investors are sometimes put off greenwashed solutions for lack of better. There are a lot of products that rolled out over the past 15 years that don't really actually make an impact, but they were sold that way. And I think that push to slap the letters ES and G when those were in vogue on anything that they reasonably could spin as being ESG, even if it wasn't really constructed to make an impact, can lead to investors shutting their brains off to real solutions out here. And that is a marketing and perception challenge that I think we all need to face. And the solution there is to demonstrate that there are things that are based on real data, that are companies that are doing good with respect to these various goals. And just as one aside to respond to that John said earlier, I think there's an interesting tension where you can be good with one SDG and neutral with others, or in some cases even bad with respect to others. You care about access to clean water. You're going to be supportive of drilling lots of wells. Right? That's great for giving clean water to folks. Not so great for the local biodiversity. And so what you care about is the life on land goal and those targets. Well, you probably don't want to be drilling lots of wells. And so it's really about investors specifying what are they trying to accomplish, and then having different vehicles that hit those different goals. And the combination of those available in the marketplace, I think, as you were saying, Laurel, can work together as a system. Those are all two things that
And thanks. Maybe we can pick up on one point you mentioned, Heather, handed to you. So maybe you can tell us a bit about what differentiates the products that you launched today from what might be seen as more traditional ESG.
Oh, a lot. You know, I think I'm going to start with what keeps me up at night, and it's really apathy, and it's the apathy of everyone. You know, and I think that the movers of our world are individual units. And there's a lot experiences that we've had that turn our brains off, perhaps, or we write it off, or we say, oh, this isn't actually doing anything. Let's go back to how it was. But we can't go back to how it was. We can't return to the past. We're here right now, and where we're going is really what matters. And so I think that is what our products are looking at. They're looking at their future. We're saying we want a future that is better than the present moment, because there are problems that we're experiencing globally that we can solve if we're collectively not apathetic about them, and we're rolling up our sleeves to solve them. And so the products that we have are different because they're fundamentally structured to incorporate ESG in them, but that it doesn't start there, it doesn't stop there. That's just one layer to the rules and the methodology that goes into the structuring of these indexes. And the other components to it, as I mentioned before, a lot of them are the traditional things you would want to see in a well executed, well managed investment product that's going to meet and beat your market returns. And then additionally to it, anybody that actually gets to the index and sits on our list is executing in a way that is solving problems. They're making money to solve problems. And that is something that really we couldn't have done. That's why today is such an exciting time. Is we're at a moment in time where we can be creating rules-based products that are aligned to a future, believing in the future, and aren't just saying, you know, we've got nice governance check boxes and we've got nice, you know, CSR departments or what have you. The things that led us to today, not to diminish them. Those are really important, but we've matured. Our products should look like that.
So if you want to head to John, then John, I'll put it to you as a two-part question. The first, as the others, what keeps you up at night, and to Heather's point on hope, and I think how critical that is, and what a critical moment it is for that. What gets you out of bed in the morning?
So that's a good question. But I do think that this is a significant opportunity, and I think we'll get to this, you know, I think later in the conversation, but this could be a decent segue. I don't think that the throughput from the capital markets to the consumers of the investments is fully aligned. Right? I think values-based investing is at the root of most folks. You know, we use the word apathy. I don't think it exists. I think the manufacturers of product and the solution provider are just using old habits, pushing old stories and old product, you know, around the 60-40 asset allocation model because it works historically based on backtesting. I don't think that's what people are trying to achieve with their capital. They want to be catalytic with their capital. They actually want to put their capital to work in a way that not only drives returns, but also advances, you know, society multidimensionally. I guess what keeps me up at night is how you kind of framed the beginning of this discussion all is the disparity that's taking place, right? It's the haves and the have-nots, and it's going back in time, and we need to change that paradigm. We need to create opportunity, and there isn't a better point in time. The world is so much smaller now. Information and education can be converted onto your iPhone technology. We have to be a catalyst for that. Information, and I think capital markets are failing because they don't have products like 17 asset management that are really the catalyst to direct capital and drive the opportunity sets. I think we're getting there. I saw some encouraging research. Joe Stevens on our team they got some great information that 80% of business leaders, ESG is a major factor in making investment decisions within their firm. It's a great stat for us to hear. You want to be encouraged about what's transpiring. The message has been heard in the boardroom that it matters, and the manage the community. Get back to what Jonathan was saying, it takes a village. It takes government, regulatory policy, and investors, and customers, and employees all to come together with one shared vision of advancing to certain goals. And I think that's the mission of helping to drive that gets me up in the morning, but also keeps me awake at night. Because I don't think we're going fast enough for people. And I grew up in Boston, and you can't tell the accent. But there was a politician in Boston, Tip O'Neill, and said all politics is local. And I do also believe that all investing is local. As products are disseminated, to people, employees, supply chains. There's a lot of people that touch all the products that we eat, that we consume, the clothing that we have, etc. And as a result of that, we have to think in that direction. I think we're starting to get there in a lot of ways. We have a long way to go, for sure, I think, but there's some significant opportunities. So, I think it's two ends of the spectrum. There's hope on one end, and then there's, we have a lot more work to do to get from here to there. It's a big world.
So Heather, I'm going to come to you next. So I'm going to ask all the panelists one more question, and then you guys are all on the hot seat on the other side here. And that would be if people here are inspired by the conversation and you want them to do one practical thing next coming out of this conversation to move towards more stable, more impactful investment, what would it be?
I think the first thing people should do is their own accounting in their own life. What do you care about? What matters to you? What is the impact that you hope to leave behind? What is the legacy you dream of? And I think that may stir up a lot of thoughts that you may have not countered. And then ask your friends, what do they care about? What does your family care about? What is the desires that the community that you're in, the local state that we operate in, the affinity groups I think we've talked about. What matters to our ecosystem? And a lot of you'll find is that what matters to you is because it's not solved. It's because it is an issue. It's because you see some sort of needs to be addressed. And then the next level of that is, okay, well then maybe putting that on one side of on the table. Now look at where your money's at. How are you making money? How is your money making money? Where is it being invested into? And right now there are some options for investment dollars or investment products that you can direct your dollars to that can have an impact. We're not alone here. We're not the first to create impact aligned products. But I doubt that you're invested across the board in impact. I doubt that you're completely exposed to changing the world with the money that your money makes for you, right? And so I think comparing those two, and then when you've kind of got an assessment of, all right, well, maybe I have a lot of exposure in equities, but they're all aligned to maybe the Fortune 500, and maybe I could reallocate some to what I really care about, which is women's equality, or perhaps it's good health and well-being. Perhaps it's, like you said, clean water or clean and renewable energy. You tell us, and then we can create something for you. And I think that's what's so fun about the products that we are bringing to market, and what we can do with these indices in the future is customize portfolio strategies to individual people's goals. Because it really comes down to the person, and I'll bring it back to the system, right? You have corporations who have to be reporting this data so we can determine whether or not they're operating and making money in a way that aligns to our goals. But why are they doing that? They're going to do it because their customer wants them to, right? So it always comes back to the individual. And if individuals are walking around apathetic, not caring how they're spending their money, not caring how their corporations that they're working for or patrons of are operating and behaving, you're not going to be part of the solution to ensuring that those corporations stand up and hold themselves to account, so that we as investors can say, yeah, you're on our list. And so I think it really comes back down to some accounting, because investing is personal.
Yeah. Yes, yes.
So that was a great answer. Seems like we build on that, but I do think it's incumbent upon everybody to reflect on where their capital is being deployed, right? To ask, those companies, that are invested in, whether it's the BlackRocks or the Vanguards or the Fidelities or et cetera, how committed are they to environmental investing? How committed are they to social change, social impact, diversity, et cetera? And we've seen some a little terrifying reactions to some of the political instability that occurred over the last few years, where some of those major institutions are walking back from commitments on climate. And I think that it's incumbent upon all of us to kind of ask, like, you should vote. Everybody should go out and vote, right? And you should ask your advisors, like, where is our money and how committed are they to environmental and social conscious elements? And, maybe they don't manage the money that way effectively, but they're part of our overall society, a major part of the deployment of capital, trillions of dollars that they manage. And, they should be held to a higher standard ultimately. And I think that if I would ask the constituents, the people watching, talk to your financial advisors about the commitment that managing their money and what that.
Well, I fully agree with what both of you said. I'm going to take this in maybe a slightly different direction, which is the growth of direct indexing as a paradigm. I think where we're at this moment in time, in addition to all of what Heather was saying, it's the interesting moment from the impact field, is we're at the confluence of two different trends. The first is a generational wealth transfer. There are trillions of dollars that over the past few years have slowly from the retiring generation to a much younger generation, and that's a generation that is much more engaged with a lot of these impacts. And we're starting to ask those questions, and you were saying, John, of their advice, how is my money being invested, not just to earn me a return, but to do good for the world? And then the second dynamic is a better technology that allows for really precise personalization and customization at scale, which sounds contradictory. And was not even possible to think of that in 15 years ago. But simple things like the rise of fractional shares and more complicated things like software that allows you to design a portfolio concept from what your goals actually are without needing to go through abundant products from the likes of Vanguards with Fidelities. Not to poo-poo anyone in particular there, but the power is in a lot of ways going back to the underlying retail investors, and that's a good thing for this dynamic here, as long as we can combat the application.
Okay, so what I might add into that, based on some work that we have done with 100 countries around the world, is where are government's commitments at right now? How are they thinking about this? Because it's a huge part of ensuring that we can make these investments, they can be sustainable over time, and they are going to have returns broadly felt. One of the things that we found when we spoke to countries last year, there was a major summit on the sustainable goals last September. So they said there's a couple of areas of the goals which we think can have multiplier effects. And we said, let's get extremely specific, not quite a trillion, but we did our best. And what we found is that countries came back to us over and over again and said, growth, so that's goal 8, growth, but not only growth, decent work, and decent pay for work of equal value, that can drive a lot more than it might be doing right now. I can see an opportunity. I can use that to drive youth empowerment, which is another one of the SDG targets. That can be important for women's economic empowerment as well too. I can see that. And they started creating these constellations. All right, I need to create a deal space within ministries and within partners in my own country so that I can make investments in a certain area, but we can measure the impact of whether or not those have been successful in other areas. So jobs came up over and over. And generally in our world, people say jobs, it comes up, it's what everybody says. Everybody wants jobs. Yeah, it's true. And there's a reason for that. But what we're finding is that there's a lot of willingness and interest from governments to say, I can do that better. Right? And we can use the SDGs and we can use a lot of the data that we have available to us that's more related to development data to be really, really precise. The other one that came up that I think is important for this conversation is governance and effective governance at all levels. That's what governments came back and said was important. We asked that same question. Okay, what do you want to unlock? What would that look like? How would you know that governance was more effective than it has been before? And they pointed to goal 8.1. They said, I want more fair economic foundations. That's what I want governance to deliver on. And for us, it was the countries that were at the poorest level of income categories and human development index. They were the ones that saying this governance improvements is got to show up in my economic foundations, right? Which is a huge opportunity space for the kinds of discussions and collaboration, public and private, that we want to see here. The third one, which is not on our agenda today, it might be on yours, so we'll hear the questions that you have for the panels with cities. Cities are such an important opportunity for us to be able to say, how do we take that next step? How do we keep it local? How do we really think together with our communities, but also do our own individual accounting? So again, I would encourage you to think about the power of cities, and that can be a conversation perhaps next year. But at this point, let me open up to the audience. I don't know how you're going to ask for a question because I don't believe it's this able to talk. But I think you can shout. Rory, you want to?
That's like, and one thing you guys didn't mention to this group
Yes.
is the cool thing about things in categories. You forget how we come to fit categories, but also product classification. You can diversify. So you're not stuck in one idea and all of you can actually say, I can't believe that all these different businesses are in the same group. And say, God, this makes sense to me. And then but the way they're approaching it, you look at whole group, not just jumping in process.
Thank you, Rory. Anybody else, please? Do you want to also introduce yourself? Should we do that here?
Yes.
My name is Dan Becker. I'm one of the portfolio managers at 17 Asset Management. I'm going to ask the question this way, though. So I'm curious for the panel, what do you believe is one of the biggest barriers for bipartisan sustainable development support?
Hard to argue with that one. It's the question of the biggest barriers to bipartisan support.
Yeah.
I think
In
it's
the US.
in the U.S.
Narrow for you.
Yeah, thank you. I'm certainly against even politics in other countries. It's that we have a system in place that rewards a lot of ways being obstinate, and until voters stop voting for that, it's tough to make change there. I wish I had a more concrete suggestion as to how we can move forward that, but I think it does have to come from the voting base saying we're just not going to support this. That we actually do need to push for solutions, not destruction.
I think it goes to your earlier comment, John, around the marketing issues. I think it's been poorly marketed, and I think the solution to going around that is changing the language we use. I think we know that there's words that trigger reactions and responses, and so what we end up doing is we really lean into the idea of intentionality. We're doing this on purpose, and we're using better data, and at the end of the day, we're making better products. And so you don't have to like them. You may not care about clean water. That's on you. And so just kind of neutralizing it. It's not a political thing. It's a human thing. It's a planet thing. And it really is about what is your intention at the end of the day. And so that's how we go about navigating the blue and red waters.
We take a slightly different tack at this because I think the history of Washington, dating all the way back, there's a lot of rhetoric. When you step back a decade or half a decade, there's actually progress. That's just surprising that you miss it. I think the IRA that was passed is a catalyst, right? We had 50 basis point reduction in interest rates, as a result coming out of inflation, which is going to be a catalyst. So Inflation Reduction Act, it worked. It was bipartisan, it passed. Republican Congress and signed by the Democratic president. Within that, there's catalytic capital for renewable energy infrastructure. Interest rates, we didn't really get into this. Some capital markets have been impacted, but interest rates being high has been a headwind of employment. Initially with solar dropping off 50% almost instantaneously, and then followed by wind. I think as a result of interest rates now coming down because of the IRA, now we're going to see greater deployment of renewable energy in the United States, which I think is going to be important because the U.S., we've increased our drilling of oil by 50% since 2014. And so today, it's a goal to increase that another 2 million barrels a day. So we haven't bent the arc of using fossil fuel. I mean, we deployed a lot of energy from a renewable perspective, but it's not sufficient. And I think that the IRA is going to be a real catalyst for this. So I think there's been advancements that they're hidden in the rhetoric for sure. And then if you look at the politics of it all, a senator from Georgia, Republican, came out and said he wouldn't vote to reverse the IRA because all the jobs it's created in Georgia and all the renewable energy and how it's improving the grid, which is under strain from all the data centers that are being put into effect, et cetera. So I think there's been progress beyond the rhetoric. Could there be more? Absolutely. I have a laundry list of things I would love for us to do. I think that does happen, people, but I think historically, how long did it take to ratify an institution? These things take time in politics, unfortunately. Yeah. Right now, with the internet, rhetoric is at an all-time, fortunately. And it's a tool I think that is being used adversely, shameful on both parties, quite frankly. But I do think there's opportunity, and I think there's opportunity, coming in the administrations potentially, and directionally where we are, building off of what we've accomplished. I think the IRA is a very good start to that. I think some of the changes that took place with the SEC, on the regulatory reporting side, have been quite positive over the past 2 years. So I think certainly those are on page 6, 7, and 8, not on the front page, but they're actually very material and be feeding into Jonathan's data sets. He's looking at financial and non-financial data to create products that are aligned to the values of investors. So it's not a great time for sure, geopolitically and in politics, but hopeful, I believe in democracy, and I think we'll advance, from the right.
If I can add one thing on to that, because that was a great point I wasn't thinking of at all. I think the CHIPS Act is another great example. You could almost call it the SDG 9.
A data point that might be interesting for you all globally as well too is that in some of our recent research we asked the question, would you be willing to commit a certain percentage of your income to fight climate change? And more than 70% of people said, yes, I would be willing to do that commitment from my income. Second question, how many people around you, if you had to guess, how many people around you do you think would make a similar commitment as you? Answer, 40%. So what this tells us is that the gap between what we think we would do and what we think the people around us would do is deep and growing. This to me is the easiest way to think about polarization. I think it's really important for you all, and for us in general, as we think about these conversations, is what might I be assuming or taking for granted. And so a lot of interesting work now is being done on how we correct misperceptions. Because without being really active in doing it, it's not the same thing as older days, just having quality disagreements with each other. What happens in these spaces of polarization enabled by digital technologies that you never find each other again. Algorithms keep you apart, and they create us other from each other, not even worth my time, not worth your time. And I think these things, in terms of starting to stitch back the kinds of conversations to get the scale and the investment potential that's there, this is on all of us to be able to do. And so one of the things I think is really interesting about the SDGs and also about impact investing more generally is that it does ask us to do a different kind of audit of where we sit. We've seen all of our social networks shrink post-COVID, all across the board in different sectors. We tend to find ourselves in more like-minded groups and smaller groups than before. So all of these are very real actions that, unless again we're seeing clearly and we're intentionally countering, you will miss opportunities. We will miss opportunities from an investment and most definitely from an impact perspective, unless we're seeing that at the scale that we're actually living in. Other questions? Yes, please.
To me all, my name is Julio Pantoja, and I'm also working as a fellow in 17 area. My question is connected with that, but it's more from the investment perspective. And It's also connected because I am an optimist of these products, of the value of the data and how can transform even the markets. And in that regards, I know you all talk about all the barriers that are in the market, but I want to ask you, if you can choose only one barrier, what would be the biggest barrier to make these products more widespread, not only in the United States, but around the world? Thank you.
That's a great one. John, should we send this down to your side first?
I'm sure. My compliance officer just took a deep breath.
So it's a fabulous question, right? So thinking globally, there's a lot of barriers to aligning to value-based investing, right? In terms of what's that catalytic capital and how does it get put to work. I think one in the U.S. is this whole ping-ponging of whether ESG investment should be in your 401k. Right? So right there, you're eliminating 50, 60, 70% of the kind of common people, not institutional capital that can be put to work into ESG. So you see these, rejections of, well, nobody's investing in ESGs. They're talking about institutional investors. They're not talking about people who may want to direct their capital that way. So I think that would be one area that I would look to it on the retirement side. On a global basis, I think we're looking at probably increased savings rates, right? Kind of redeploying that capital into equity and fixed income markets, longer term investment horizons that I think would be very much aligned to where they want to put their capital. So people investing in green bonds, as an example, would be really catalytic in terms of deploying capital behind missions of that. So it's a tough question because there's a lot of regulatory headwinds. I think that the biggest issue, though, are how gatekeepers think about ESG. They think of it as thematic and not core, and it's just wrong thinking. It's environmental impact, social impacts, governance impact. The materiality map, which was based on work that Dan Harrison had done, was indicated that governance was the greatest alpha generator out of that, and it matters. And I think some of the research that we're seeing now, that boards of directors are taking environmental and social factors in a much more meaningful way, show that governance is a driving factor to the other sides of things. So I think asset allocators have to start thinking about SRI or ESG or as a thematic and more as a risk and an opportunity within the investment thesis. And I think that would be a pretty good catalyst. No idea whether I answered your question.
No, I would say thank you for the question. I know that in the way that we're thinking about our products, we want to be able to ensure that they're built to move through these gatekeepers and to get into people's portfolios. And so one of the things that we're really excited about is how simple we're able to make them. And it's a clean, clear opportunity to get exposure to any of these themes, any of these goals. And ideally, what we're doing in breaking down those barriers is getting those products on the shelves of advisors so that they can offer them to their clients. And that's really on the institutional side. Getting them into 401ks is a whole other ball game. But my real dream, and this is down the line, and we'll see how fast we can make it happen, but is retail, is to have people be able to go into whatever platform they want to put their spare dollars into, and we're one of the options they have available to them. They can say, I'm exposed ABC, but I also have my climate change exposure, right? And that is something that I really care about. And I think in those cases, those platforms that are wanting individuals to be investing through them, we're going to use our products as the calling card for people, for galvanizing people to adopt those intermediaries. And so I think there are a lot of barriers, but I'm hopeful having products that are catchy and exciting and also simple will help break them down.
Yeah. In a nutshell, time, I would say it's to something Laurel said earlier, it's about the multiplier effect. And I think investors, especially retail investors and a lot of advisors, don't fully appreciate that investments in these kind of SDG aligned or impact aligned products are going to reap benefits, maybe not in the next 3 months or 6 months or a year, but they're going to reap benefits not just for the companies that are directly doing that, but for the whole economy. And so this is an area that's worth investing in. And it's very easy for folks to lose sight of that when all they're doing is looking at the daily stock chart. So if I could wave a magic wand and remove one barrier, I think would be that appreciation of the multiplier effect.
I think there's one more for you, please.
Give me a sales pitch. This is okay. You just said it's SDG 9. It's the CHIPS Act. You know, also somebody's in this. Why they're so interesting. I mean, it's really the cool story here. It's not just indexes. They really need businesses that are being simulated on the rise, and investors wouldn't think of that.
And while you do that pitch, why don't you also tell us why you pick certain SDGs to move with first, fastest first? Tell us about that.
It's fun.
Yeah, so I'd say these are products that are just in the companies that are doing good with respect to specific goals and targets that underlie those goals. So for SDG 9, we're looking at companies that are innovating and producing infrastructure. Think someone like Rockwell Automation and what they're doing with sensors and industrial automation equipment. Right? They are selling a product that's going to help solve that problem. For SDG 13,
Industry.
yeah, and then there's just a smattering. There's lots of different kinds of companies that are helping each of these. But we're trying to focus on companies that actually their products and services are relevant for solving those SDGs. And let's avoid the companies, I'm not going to hold Exxon in the portfolio that's trying to focus on climate change. That doesn't make sense to hold them there. But it does make sense to hold companies that are investing in fuel cells or solar technology. For SDG 3, it makes sense to look at the companies whose the health and well-being, companies that are helping solve problems for diseases in developing countries and tropical areas. There's a target that's all about from malaria and AIDS and other developing nation diseases, right? And there are companies out there that are specifically making those kinds of products. So let's put them in an index. And we can do that, as I was saying earlier, in a rules-based and transparent way. And it's passive investing alongside the impact.
Thanks.
No, thank you, Rory, and thank you, Jonathan. I hope everyone can see what a perfect partner Syntax is to 17 Asset Management and their deep commitment to ensuring that data allows us to build the products that we want to be building. Before we met you all, it was much harder to do what we're trying to do. And so kind of just building on that and your question more around why we started where we started. So our first index was SDG 9. We launched SDG 9 earlier this year. It's actually on the SmartX platform. And if you are a client of SmartX, you can go allocate some dollars to it today. And as of today, we're launching our next 5 indexes. And so we have 2, 3, 6, 7, 9, and 13 as far as SDGs and the goal. So 2 is food and nutrition, 3 is health and well-being, 6 is clean water, 7 is energy and renewable energy and affordable energy. And 9 is industry and infrastructure, and 13 is climate change, climate action, and there's multiple tiers to that. Are you responding, or are you mitigating, or are you adapting? There's a lot of layers to all of these goals. And the reason that we started with the ones that we did is because we want to meet the market where it's at and hit the impact desires and needs that we're kind of collectively acutely aware of. In time, we will have an index for each of the goals, and that will allow advisors or individuals to sit down and to customize a portfolio that is filled with top tier companies that are outperforming their peers and also aligned to deep impact goals.
Maybe I'll take a little different tack to this, thinking about as an investor where opportunity resides. We believe that energy infrastructure in particular and infrastructure in general is a mega trend. It's going to be a long tail trend. There's going to be a lot of capital that gets deployed in infrastructure on a global basis. We see it as a fabulous investment opportunity. As we've seen a lot of opportunity within education and waste in water. There's been a tremendous amount of innovation that's taken place over the last decade. It's moving through the pipeline. We're seeing some pretty exciting things as it relates to synthetic fuel taking place. And I think a couple of $1 billion put to work by firms like Brookfield, as an example, TGC is another that could be transformational. Now, they're not at scale at this time. They will be working their ways into the public markets and into opportunities. So we're seeing within the pipeline, as sustainable leaders, we invest in both public markets and private markets and private credit. So we do see the entire paradigm, if you will, on a basis. And we're seeing some very exciting themes materializing. Some of these SDGs that 17 Asset Management is launching. And so, the pipeline is exciting. We believe that these are really good investment themes to be overweighting into as you're thinking about your portfolios. If you're in core strategies, you're probably 20, 30, 40% in technology. Where else do you want to deploy your capital? Technology has been a good investment, because it certainly has been. But we do believe that there are others that are catalytic and are also really significant mega trends for investment opportunities, which bode well for investing in these SDGs.
Maybe share an interesting reflection on the six that moved first. And then John, I'll come over to you as well too. What's interesting about that is that the SDGs, of course, build on previous development agendas. And the first six of the SDGs, talk about food, water, some of the other fundamental areas, health, are sometimes what we refer to as the unfinished business, the SDGs, and Bernard knows all of this very well too, right? Because these are huge challenge areas. When you unlock progress, sometimes the directionality is different. Sometimes your work in other areas, economic growth, towards different outcomes, actually has an impact on overall poverty numbers, for example, in those first six. You make some investment choices early in those goals. What's different about the SDG agenda is an explicit recognition of growth and economy as a vital part of driving any of these solutions forward. And you've also chosen some of the goals in that area as well too. And again, what's different about the SDGs, and it's not, but the intention remains an important one, is that it connects in environmental and climate goals in the same space. And I do a lot of work around connecting these agendas because we say it, but we don't yet do it, right? But it's exciting, and it's a huge opportunity to see the way that we are starting to do this across different industries, and certainly in the investment spaces and in these indices. You are covering the three fundamental areas of development, which are social, economic, and environmental, in the way that you've taken forward those first six. John.
I would just be excited about it again when he said sales pitch. It triggered me. So I have to give a little bit of a sales pitch about this moment in time, about these indexes. They don't exist in the world today. There are SDG indexes, but most of them are either European or they're across the board as one index for all SDGs. No one has created a US portfolio of traded securities for each SDG. What that means is these are institutional opportunities as ingredients for sovereign wealth funds who want to buy US listed stocks and may not want to pay the managers, but know that what they're buying is a basket of securities that align with the SDGs that those pension funds are very committed to, whether it's Norfund as a sovereign wealth fund, or the Arab sovereign wealth funds, or Ontario Teachers, or CalPERS. Buying a basket that is predetermined and is reliable to these SDGs is about. Then, as much as we talk about the large institutions, they all want the asset managers. They want products. Because they've burnt themselves a little bit. So these indices can be ingredients for ETFs, for those who want to build ETFs around these, and they will be authentic. And so we're excited about what these can be used for, and those who want it managed and maybe customized. We have a portfolio management team that can do it, and those are the model portfolios. But for say sales pitch, I got to jump in.
Thank you, John. All right, I'm going to wrap this up. I believe I'm standing between you and reception. It's fun to drag out for a minute, especially if I'm used to doing this in the UN, but I won't. But what I do want to say is that I think it's because thank you to everyone and thank you for the organizers and hosting. And it's a privilege. So I'm not always in these spaces, and it's wonderful to be part of this. It's very exciting. And I would leave you with that in 3 pieces of homework that applies to the people joining online too. And you can think about this during the reception as well too. So the first thing, what was something that you heard today that really resonated? Yeah. So what we want to do is take a conversation like this and get the most out of it. So number 1, what was something that resonated, something that you were interested in, whatever it is, what was that thing for you? Think about what that was. Number 2, if you were going to meet up with somebody later tonight, get on the phone with somebody, what would you tell them about this event? It's the most powerful way of sort of connecting to something is saying it back to others. What would you say? How would you describe it? And number 3, if you had to take an immediate step tomorrow, not next year, not when things are better, not when things are perfect, but tomorrow, which will be a lot like today, what would that be? So I'll think about that too. Rory's going to think about that too. Pam will think about that too. And really, thank you for joining us.